Every news channel tells you the same story. Government debt is rising, budgets are tightening, and future generations are doomed. But no one ever answers the real question. If every country owes money, who is the world actually paying? Who is collecting the interest? And why does the debt never go down, only up? Here's the part you were never supposed to look at too closely. Government debt isn't a glitch in the system. It is the system. A machine designed over centuries by men you've probably never heard of. And once you see how it works, you'll never see taxes, banks, or government promises the same way again. The world today owes more than 3 times the value of everything it produces. Trillions piled on trillions. Debt stretching across continents, stitched into every pension fund, every bank, every government budget. But the terrifying truth is this: the world doesn't owe money to some mysterious outside force. It owes money to itself. A loop designed carefully across centuries, locking every nation into perpetual payments that never end. To understand how we got here, you need to see the blueprint. A blueprint created not by presidents or kings, but by 4 financial architects whose ideas reshaped civilization. Each of them solved a crisis in their era. Each created a mechanism that made debt bigger, longer, more permanent. And together, they engineered a world where borrowing never stops and interest never stops flowing upward. Before these architects appeared, debt worked the old-fashioned way. Kings borrowed from wealthy merchants. If they couldn't pay, the lenders took a loss, and the crown was embarrassed. But life moved on. Debt was temporary. It rose, it defaulted, it reset. There was no global system. There were no perpetual payments. There was no concept of national debt forever. Then came a Scottish merchant with a vision that would flip the entire equation. He walked into the English court during a desperate moment, offering money the king couldn't get anywhere else. But his offer wasn't just a loan. It was a structure, something brand new, a loan that the government would never, ever repay. Only the interest would be paid, drawn from taxes, forever. And to administer this strange new machine, he proposed a national institution unlike anything before, a central bank. When Parliament approved the idea, something irreversible happened. Debt stopped being temporary. It became permanent policy. The government paid interest every year. The principal stayed forever. And the bank issued notes backed by that debt, turning the government's IOU into currency itself. Money literally created from borrowing. The more the government borrowed, the more money the bank could issue. This wasn't a bug, it was the design. A design that spread across Europe in less than a generation. France copied it, the Netherlands adapted it. And when the United States was young and fragile, it adopted a version of the exact same model. But permanent debt wasn't enough. It needed something else: scale, liquidity, tradability. That innovation came from a banking family whose influence stretched across Europe. They connected cities, currencies, and governments with a network faster than any official system. And they realized something profound. Debt didn't have to stay with the person who originally lent the money. It could be bought, sold, traded like a commodity. Government bonds became an international product. A French investor could own British debt. A German bank could use Austrian debt as collateral. A Spanish investor could sell a bond in Paris before lunchtime. The web grew so dense that defaulting didn't just hurt one creditor. It threatened the entire network. Default became almost impossible, not for moral reasons, but because the system itself would collapse. governments became locked into continuous repayment, not repayment of principal, just interest, endless, upward-flowing interest. The world had taken its first step into a trap built from paper, contracts, and confidence. America, meanwhile, was growing into an economic giant with a chaotic financial system. No central bank, no unified control, money tied directly to gold. Banks failing unpredictably. Then a crisis hit, markets falling, banks collapsing, panic spreading. And into that vacuum stepped a titan of American finance, who acted like a one-man central bank. He forced competing bankers into a room and made them fund a rescue operation with their own money. It worked, but he knew the system wouldn't survive the next crisis. So, a secret meeting took place on a quiet island, a meeting that would decide how American money works to this day. The name central bank was avoided because the public hated it. So they gave it a new structure, a new name, a new disguise, a network of regional banks, privately owned, but wrapped in the appearance of public oversight. This was the birth of the Federal Reserve. The key wasn't its structure, it was its power, the ability to create money. The ability to buy government debt with money created out of thin air. This changed everything, because it removed the natural limit on government borrowing. Banks once had finite funds, the Fed did not. The government could issue more bonds, and the Fed would buy them forever, on demand. With that mechanism in place, debt entered a new era, an era with no cap, no ceiling, no natural stopping point. As long as the central bank existed, borrowing could go on infinitely. But this infinite engine hit a new limit in the developing world decades later. Countries that borrowed heavily at low interest rates suddenly faced rates double or triple what they expected. Their economies couldn't handle the payments. A wave of defaults loomed. If those defaults happened, major Western banks, especially in the United States, would collapse overnight. So a new architect stepped in. His solution wasn't forgiveness. It wasn't allowing the losses. It was restructuring, a new type of loan that kept the old interest flowing. A loan that demanded political obedience in return. A loan that didn't fix anything, just kept the trap closed. Austerity, privatization, currency devaluation, cut social spending, open markets, sell national assets, comply or lose the rescue. This formula repeated again and again across continents. The debt remained. The interest kept flowing. The sovereignty weakened. By now, the trap was global. Every country participated. Every country owed. Every country held someone else's debt. Japan held American debt. America held European debt. Europe held developing world debt. The IMF and World Bank connected everyone in a circle without exits. Here's the modern mechanism. The United States issues trillions in treasury bonds. American institutions, pension funds, mutual funds, insurance companies, and the Federal Reserve buy those bonds because they are considered the safest assets on earth. Those bonds pay interest every year. Taxpayers pay that interest. The institutions collect it. Workers fund the system. Capital receives the profits. The rest of us, debt sits inside government trust funds, meaning the government owes itself. But ultimately, taxpayers foot that bill too. When those programs need the money, the government either raises taxes or borrows more. Now scale this globally. Every major nation uses the same playbook. Borrow, roll over, pay interest, repeat forever. Here's the part nobody tells you. If governments tried to pay off all their debt, the money supply would collapse. Because dollars, euros, yen, these currencies are created through debt. Paying off the debt would erase the money. The global economy would implode instantly. The system requires debt, not occasionally, not as an emergency measure, permanently. And the beneficiaries aren't presidents or politicians. They're the institutions that hold the bonds and manage the money. The giant asset managers, the central banks, the major lenders, they earn the interest, they control the collateral, they benefit from expansion. They are the quiet winners of a system most people don't understand. This is why government debt keeps rising, why it can't go down, why every crisis leads to more borrowing, not less. The machine demands continuous fuel, continuous interest, continuous expansion for architects, for innovations, permanent debt, global debt, infinite debt, inescapable debt, a system so deeply embedded that escaping it would collapse everything built on top of it. The debt isn't the problem, it's the foundation. The interest isn't the consequence, it's the harvest. And every person on earth lives inside the machine they built centuries ago. If this changed how you see government debt, if you now understand why the numbers keep rising no matter who's in office, then you've taken your first step into understanding how power really works. Because they'll never teach this in school. They'll never explain it on the nightly news. But if you want to understand the machine and the people who still operate it, there's much more to explore.